Welcome to everyone joining us this afternoon. We've had a great turnout for what we hope will be a lively discussion. For anyone that I have not met, I'm Eileen O'Connor, co-founder and CEO of Hemington Wealth Management, and I'm delighted to welcome Dr. Apollo Lupescu to our conversation this afternoon. Apollo is Vice President at Dimensional Fund Advisors, which, as many of you know, is one of the premier investment managers in the world, managing more than $500 billion in client assets. Apollo earned his PhD in economics and finance at UC Santa Barbara and has, over the past 16 years at Dimensional, become an internationally recognized speaker who's delivered hundreds of lectures and seminars to both financial professionals as well as individual investors because he excels at explaining investment concepts in a clear and understandable way. I personally have worked with Apollo for many years, and since he's addressing questions from clients across the globe, including me, I thought it would be a great opportunity for Hemington clients to hear from him directly.
Before we jump in, I'd like to clarify Hemington Wealth Management's relationship with Dimensional Fund Advisors. As a fiercely independent firm, we have the universe of investment options available to us. And as such, we have no economic relationship whatsoever with any investment managers, including DFA. But that being said, Dimensional is a leader in the industry and continues to be an important partner for us, as we're very much aligned in terms of investment philosophy and how we think about issues like we're going to be discussing today. So before we jump in, just a couple housekeeping items. We were planning a town hall type of event tonight, but given the large number of attendees, we had to switch to webinar mode, so you will not be seeing the other attendees. We have muted all participants. However, you can use the Q&A feature at the bottom of your screen. The chat feature has been disabled. So if you have a question, by all means, put it there. For privacy reasons only, Apollo and I will see it. If we don't get to it in this short hour, your Hemington team will be following up with you after this session. And then lastly, in an effort to be respectful of everyone's time, including Apollo's, we're going to have a hard stop right at 6 p.m. Okay, Apollo, thanks so much for being here today. We've taken some time to aggregate our high net worth clients' most common questions and concerns, and we wanted to get your perspective on the top 5. So first, I'll start with the name of the event here, the upcoming election. So it seems that the country is more polarized than ever. We have had the most questions and concern raised by our clients about the current state of the union that I personally can ever recall in my history of being a financial advisor. And of course, this is understandable given the stark differences between the different proposals, especially as it relates to taxes, not only income, but capital gains and estate tax system as well, just to name a few stark contrasts between the parties. What are the implications of a Republican or Democratic administration? And as investors, how can we be best prepared no matter what the outcome?
Right. Well, first of all, Eileen, thank you so much for having us. And I do recognize the background. I think we had an event a few years ago, and I can't wait to kind of get back there. So thank you for the invitation to be here, and thanks to all of you online for attending. And it is a big question. And perhaps before I get going and try to dive into this, one quick logistics. If you use a Windows computer, on the right-hand side of the Zoom window, there are 3 icons. There's an X, there's a square, and a line. And if you click on the square, that would maximize the window and put the video over the entire screen. And that would help with seeing maybe some numbers later on And if you have a Mac, it's on the left-hand side. I think there's a green dot with a plus sign. And once again, that turns the video over to the entire screen. So that, from a viewing perspective, not that you need to see me in great detail, but later on, that might come in handy. So let's talk about the election, because as you said, I think it's a great way to start it. And particularly the word that he used, polarized, is a really good one, because that's what it feels like. And we're not really listening to each other, and we're listening more to reply than to understand what the other side is saying. And it feels different. And to begin with, I would say that in general, politics, it touches on our deeply held beliefs and our identity as individuals and core values. And because of that, it is a very, very emotional subject. And there's nothing wrong with feeling emotions around politics and this election cycle, and nothing at all. I think that the issue is that when it comes to making decisions about money, are these emotions always leading us to great decisions? And frankly speaking, in my life, not even talking about investing in general, whenever I was clouded with emotion, I'm not sure decisions are made were always in my best interest. And particularly when it comes to investing, there's quite a lot of evidence that emotions don't play a really positive role in outcomes for investors. So what I'm suggesting is this: I would love to acknowledge these emotions and validate and make sure it's absolutely okay and understandable why you're having them. Our job and Eileen's job is to pay attention to them and at the same time disentangle these emotions from investment decisions. And whatever I'll be talking about is not trying to make you feel good or bad about your political views, but rather when you look pragmatically at the election from a numbers perspective, when we analyze the data and the evidence, the question is, what do we see there? What are some of the lessons that would help all of us as investors? So the perspective that I'll give is not, again, partisan in any way. I'm not going to tell that one is better than the other in any way, policy wise, whatever. What I'm going to suggest is let's look at the numbers and see what is the story that the numbers are telling us. And I'll start with taking a step back is that in these uncertain times, people are asking, well, does an election to begin with actually involve more uncertainty, and shouldn't this additional uncertainty make the markets behave differently than otherwise would? Because there's that wisdom out there, don't know where it came from, but the markets don't like uncertainty. And whenever uncertainty pops around, that's not good for the market. So to begin with, let's look at elections at the market. And elections have been around since 1776 or so, since we became a country, but stock market data only goes back to 1926. So we have 94 years of good data. And the stock market here will be represented by something called the S&P 500, Standard & Poor's 500, which is a collection of the largest companies in the U.S. stock market. So when we go back to 1926, over these 94 years, what we see is that we have 23 different presidential elections. So that's a pretty good place to start. What are we seeing historically when it comes to election years? How different are they? And is it a good thing or a bad thing for the market to be in an election year? The place to start is just look at an average. When we have these 23 different data points, when we have these election years, what do we see the market doing on average? And on average, does it go up or does it go down? When we ran the analysis, what we found is that on average in these 23 different election years, the market actually went up by an average of about 11.3%. So election years by themselves, it doesn't mean that it's doom and gloom and it's a terrible thing for the market. On the contrary, the market does go up quite nicely on average in an election year. And one more thing, this average is not vastly different than non-election years. So again, it doesn't seem that being in an election year is vastly different than being in a non-election year. But average quite often means that the market goes up, or it could actually go down. And I'm going to ask you, I know I wish I was in the room to ask you, but put a number in your head. Out of the 23 elections, how many do you think that the market went up, had a positive return that year versus a negative one? And we ran that analysis, and what we found is that out of the 23 different elections, 19 out of the 23, the market had positive results, meaning it went up in an election year, but there are 4 years when it went down. What's interesting is that the majority of the time, the preponderance, the market tends to go up in an election year, but not every time. Once again, when you look at the difference between election and non-election years, this split between positive and negative years, it's a little bit better than non-election years, but not by much. Once again, it's an indication that being an election year is not necessarily doom and gloom for investors. And what I thought might be interesting is to perhaps take a closer look at these 4 instances when the market did go down and see if there are any lessons from which we can learn to help us cope with the current situation. And what I found is indeed there's an amazingly useful lesson that we can learn from this. So let's look at these 4 instances one by one. The first one is 1932. And in 1932, we had FDR versus Hoover. The market went down by about 8%. But there was also the worst year of the Great Depression. So we did have an election, but we also had the Great Depression. 80 years later, in 1940, once again, a negative market return in an election. But that was the year when Germany invaded Europe, and it became obvious this would become a world war. And it took 60 years during which we had, discord in the country. We had civil movement. We had a presidential candidate shot and killed. And it wasn't until 2000 when once again we saw it. And that was Bush versus Gore. And I do have to say that if you look at Bush versus Gore, that was a contested election. We did not know the winner the night of the election. It took some time. It went all the way to the Supreme Court. But eventually, as a country, we sorted it out and we moved on. Now, is there something there that because it was a contested election, that would necessarily mean that the market's not reacting very well to that? Well, it turns out that by the time election came around, by the end of October, the market had already dropped. And why is that? Because of pets.com and a lot of these high-flying tech stocks that were going down in value. So yes, we did have that election, but we also had the beginning of the dot-com bust. And then the last one, obviously, in 2008, had to do with the financial crisis. So as an observation, what became really apparent to me is that in every single year, in every single case when the market dropped in an election year, there was something a lot bigger going on in the world rather than just the election itself. And it's a really important thing because it's going to lead to one of the primary conclusions that I'm going to put forth, which is that elections and politics are a variable when it comes to the stock market, but not the variable. It is not the main driver of what the market does. As much as the media would like to make that causality, it is not the case. There are a lot bigger things happening that might drive the market rather than who is in the White House. And frankly, nobody can quantify this, but if you ask me, I would say that how much do politics and elections matter? 5, maybe 10% of what might drive the market comes from the elections and politics, but it's a relatively minor variable in the big scheme of things. Look at every single instance when the market dropped and also when the market went up. Was it driven by the election of president or not? And one more note here, I think it's important. What I'm presenting here is a whole year. And the reason I want to bring this up is because around election day, it is quite possible that there will be fluctuations in the market. Remember 2016. The night when the election was called, the market tanked. It dropped significantly that night, and yet by the end of the first day, it moved up higher. So there's a lot of bounciness around election day, and if that happens again, I wouldn't be surprised. And it's possible that we might see this time around. It's a little bit like if you have a rock and you throw it into a lake or a pond. At the point of impact, the ripples could be quite big. So that's the election day, and maybe days or weeks before that, you're going to see on either side of the election maybe some movements in the market. It wouldn't be unusual. We've seen that in the past. But the further you move out away from that election day, the more these smooth out to the point where they become insignificant. they become like election. Well, it was like, that was old news. And that's kind of what we see in the past. And the reason I bring this up is because stock market investing shouldn't be about a week or a month. It should be much more considered in years. And that's what I'm showing you, years, rather than what happens on a weekly or a daily basis around the election. So again, in that respect, it does seem that this is not the primary variable, that other bigger things might drive what happens in the market. Now, to the question that you asked, Eileen, what about presidents? How much do presidents matter? Does it matter if we have President Biden or the current administration? And when we looked at this, instead of going back to 1926, just to make it easier, I went into my lifetime, and I'm born in 1969. And when I was born, President Nixon was in office. And for the 5 years or so that he was in office, on average, the market actually dropped about 3% during his tenure. And then President Ford came along, and on average, during the couple of years that he was in office, roughly, the market went up about 20%. And if you fast forward and you look at the different presidents and the average annualized returns per year during their time in office, the first thing that became very apparent to me is there's no discernible pattern to tell you that having a Republican or a Democrat is better or worse for the market. I just don't see it. It just doesn't seem obvious at all to me to see that pattern. And in fact, I would take it a step further and say that a president should receive neither credit nor blame for what happens in the market during their tenure. Why? Take President Nixon. We talked about it, negative 3% on average per year. Before he set foot in the office, there was a move to change from the gold standard to the type of currency that we have today. And, there was some, initially as we changed, there was a big change, and there were some situations that arose. In the early 70s, because of a crisis in the Middle East, OPEC imposed an oil embargo against the U.S. before. Should President Nixon be blamed for that because the market didn't do well? I don't think so. It's not fair. The same with George W. Bush. Just as you walked in the White House, the dot-com started to unfold, something he had nothing to do with, and it was on for years afterwards. 9/11 happened 9 months into his term, and he walked off at the bottom of the financial crisis. Should he receive blame for that? Absolutely not. The same way that President Clinton, he happened to be in office when these big tech companies got formed. That just happened. That's when they got established. The Googles and the Yahoos and the Microsoft, not the Microsoft, but the Googles and the all these giant tech firms that we know today. And it just happened to be there. The Amazons, and he had good returns during his tenure. Should he receive credit? Again, this is not about a public Republicans or Democrats. It's just simply looking and saying there are a lot bigger things driving the market than who is in the White House. And for that reason, I don't believe that a president should receive credit or blame, because there are so many other things that might impact the returns during their time in office. Now, there's the other question that he kind of touched on. What about taxes? Because I think a lot of investors are looking and saying, well, of course, tax policy has to matter, and how much is an impact? How much does that impact the market? Having a president with a business-friendly attitude and also tax cuts, well, certainly seems to benefit the market, whereas other presidents that might raise taxes, that can be that good for the market. And once again, we can look at the evidence. When you look at the numbers, President Reagan, really well known for tax cuts, particularly income, big slash to the income tax rates, and really market did very well. $1 invested at the beginning of his presidency, by the time he left, would have more than tripled to $3.24. Which is great. You triple your money in 8 years. The market did really well during those times of tax cuts. We also had President George W. Bush, and he had 2 rounds of tax cuts, some specifically targeting investments like long-term gains and dividends. And he had $1 invested at the beginning of his presidency would have turned to 70 cents 8 years later. So tax policy does not guarantee, and tax cuts do not guarantee good returns in the market. President Clinton, in fact, had higher taxes, but it seems that the market also did higher than either of these tax cut presidents. So to me, I would be cautious about making a judgment that these might be good or bad. Individuals and companies have had to deal with higher taxes for many years. What did companies do up until a few years ago? You create a subsidiary in some other country with a lower tax rate, and you do some asset transfer pricing, and then you find a way to mitigate taxes. They've done it. Eileen has done this, and Hemington has done this for a long time. And if taxes do change, and we have no idea how they'll change, but if they do change, whether it's estate planning taxes and all that, first of all, they might or might not impact the market. But secondly, they know how to deal with this. They've dealt with this for many years, and they're perfectly legal ways to either use more tax efficient investments or to create something called loss harvesting or asset location, their trust. I mean, there's so many things that you can ask your advisor if taxes do change. It reinforces their value more than anything else. And I also want to be cautious, because when people are also saying, well, but ultimately this is not going to be good for the market if we don't have these, business-friendly presidents, it's not necessarily doom and gloom. If you look at 12 years ago, as I was on the road, not just in Virginia, but pretty much across the country, particularly in some parts of the country, where they're not really excited about the prospect of perhaps President Obama coming into office at the time, was still a candidate. They're really concerned and saying, this looks to me like a socialist type of government. They cannot be good for the markets, and I need to pull my money out. And I heard this over and over and over again. And what's interesting is that if you look at President Obama, really known for helping millions with healthcare and Obamacare, what happened to the market during his term? 2 terms. What happened was that $1 invested at the beginning of his presidency would have more than tripled by the end when he left 8 years later. And you know what's remarkable? It is similar, in fact, eerily similar to what happened during the Reagan years. So whether you had somebody who is really well known for Obamacare or somebody well known for the tax cuts and of the Reagan years, the market pretty much responded identically. And that's what I'm really cautioning people not to go out there and say, well, I need to make a move of my money either because I'm excited or not excited about the prospects of what might happen with one president or another. It will not matter for your money, whether it's President Biden or President Trump. A lot bigger things will drive, and I'll tell you in a second why. But before we go to that, I do want to touch on one other thing that I find is important, Eileen, and that is that White House is important, but all these spending laws and tax laws do have to be passed by Congress, the legislative branch. So what do we see when it comes to Congress? Going back to the 1920s and looking at the market and how it did during Republicans and Democrats, the only trend that is apparent is that the market tends to go up irrespective of who's in control of Congress. Democrats were in control of Congress for many years, and the markets went up quite nicely. And so were Republicans, and the markets went up. But in neither case does it appear that the market had a smoother ride on the Republicans or Democrats. There was a 73, 74 bump right here, and there was a dot-com bust with the Republicans. So in either case, it doesn't seem that it's a perfectly smooth ride, but it is the market is rewarding long-term investors. And to me, the one statistic that it's so important is looking at something that is called unified government. And the reason I think it's important is because right now there is perhaps a thinking among some people, what if the news and what you hear about the blue wave coming in and sweeping Congress, what would be the impact to my money of that situation if it does actually pan out the way that it's going to put out there in the media? And let's look at this idea of a unified government. And what it means is that Senate, the House, the Senate, the House, and the White House all belong to the same party. That's the word that I would use, unified, not because everybody kind of plays along and it's kumbaya time. No, but it's just unified, meaning that the party controls the House, the Senate, and the White House. And if you look at the Republicans, they have had this unified government for 13 years over this time frame. And if you look at the Democrats, they have actually had it for 37 years, so a lot longer Democratic control of these three at the same time than Republicans. And when we ran the numbers, what we find is that during these 13 years of unified Republican control, the market on average returned 14.52% to investors. So it's a really nice growth. The question is, what did we see when it came to the Democrats during these unified Democratic times? Well, the average was 14.52. Identical to the second decimal. And it's not an error. We kind of went over this twice and several times, actually. It is identical to the second decimal. Just to show you how little does it matter if you have a Republican or a Democrat unified government. It's just basically it's not the primary driver of the market. So it's really important to note this. Now the question is why? Why do we see this, and what's the underlying reason that we're suggesting that this doesn't matter? And to me, the primary reason is because us as individuals, we don't change our behavior as a government changes, a president changes. 2 weeks from now, half the country will feel very optimistic about the future, what it's the market, it's the economy, and half will be pessimistic. If you're on the losing end, you're not going to feel great about where the country is going, the market and the economy. Roughly half will. But everybody, whether you're feeling pessimistic or optimistic, what we see is that they are resilient and they will continue to do the things that they did before. It doesn't matter who's in office. Will you eat fewer blueberries? Will you buy fewer boxes of Cheerios and go to the bowling alley more or less often? You're going to carry on what you do. And that's why it's so important that we don't change our behavior as consumers in response to that. We might not like policies, but the day-to-day things that we do, they're not going to vary very much. And companies will continue to seek opportunities and continue to seek profit opportunities in whatever state of the world we're in. They're going to look for that. And as I said, profits, if you think of Apple, what do you think matters more? The products they have, the services, competition, the strategy, how they execute it, what's going on in the world, or who's in the White House? What's the primary driver of profits, which really determine the value of a stock? I would, again, say that it's something that it's under their own control. So people are resilient, and that makes companies resilient. And because companies are resilient, so will the market. And to me, that's the fundamental thing. Irrespective of whether Donald Trump or Joe Biden is president in January, that fundamental premise of free markets and capitalism will not change. Companies will seek opportunity under whatever circumstances, and their profits are more likely to be impacted by things that are either under their control or much bigger things happening in the world rather than the policies in Washington. So I've been talking for quite a while, Eileen, and I want to make sure that it doesn't become a monologue, although it has been a monologue so far.
So appreciate it. And I love exploring whether there's a connection between current events and investment returns, because you can talk about the election or many other topics, and the story is kind of the same. So I really appreciate that. And for our Hemington clients, we talk a lot about having a non-forecasting investment philosophy, right? I think some of those slides really point to how difficult it is to be able to forecast into the future and win, right? It's not always as intuitive as it might seem. And then the second comment I'd say is, thank you for mentioning, but when there are large changes, right, it's our job to uncover the financial planning opportunities, right? And that's what we spend most of our days doing. So thanks so much for that. So,
I mean,
next, Apollo, you and I have been through quite a few market ups and downs, right, over the years. But this crazy year, 2020, really does seem different and cause for concern on a different level. The pandemic has touched each and every one of us, and there doesn't seem to be an end in sight. In fact, the economy has now hit pause for the second time. Millions of Americans are unemployed, and the virus might continue to impact us in multiple ways. And yet there seems to be a disconnect between this dire economic situation and the stock markets reaching all-time highs, especially the NASDAQ, which is up 30% through the end of August of this year. Right. So this has been perplexing for many investors and unfortunate for those who moved to gold or cash at the worst possible time this year, not Hemington clients, of course. But what, or as investors, are we to make of this?
Yeah, no, it's a really good question. And I would say that there are two sides to this. There's one side that I'll touch about in general. How do we disentangle the market and the economy? And then I'll discuss specifically what's been going on this year. So the broader picture, quite often in the media, you hear about the economy and the market, and they're kind of interchangeable. What's the difference? They are related, but they're not the same. And it kind of really became almost like a visual to me when I watched my daughter. I have a 13-year-old daughter, and not long ago we got a puppy. And as she was walking the puppy, I could see that my daughter had a pretty steady pace, sometimes a little faster, sometimes slower, a pretty steady pace, whereas our puppy was kind of moving all over the place. Yet eventually they got to the same place together. So it's a little bit like that. The economy is steadier, sometimes faster, sometimes slower, but the market tends to move a lot more. And why is that? Why is it that they're related, but they're not the same? And the reason for that is that the economy has much more to do with our paychecks right now. What's the economic outlook? What's not outlook, but what's the economic output? What's the inflation level? What's the unemployment rate? All of these impact businesses right now. The stock market gets you ownership into a company. That's what you buy in the stock market. And because you buy the ownership now, you are entitled to part of the profits that the company will pay for many, many years down the road. So in that respect, if the economy is your paycheck right now, the stock market is your paycheck from the future. So there is a difference between time horizons, and that's what makes the economy always disconnected from the market, because they don't have the same time horizons. And in fact, what's interesting is that the markets are forward-looking because they are looking in the future, and sometimes they anticipate that the economy could get worse and yet go up at the same time, because what they're seeing is, things are going to get worse, but we see light at the end of the tunnel, and we don't have to wait for that. We can price that in before it actually happens. And a great example is looking at 2009. In 2009, even as the economy had the worst year of the financial crisis, and in generations one of the worst year, that year the market was up 26%. Because what it did see, things are going to get worse in 2009, but we see there's light at the end of the tunnel beyond that. And they priced it in before. So markets do try to price this in ahead of time. So anything that is expected is priced in the market earlier before it actually takes place. So markets and the economy, they've always been disconnected because they have a different time horizon. And the way that I think about it is, if you remember the film, do you remember the black and white film? I used to have a lot at home, Eileen. And to me, the economy is a snapshot, is a frame. Whereas the stock market's a much longer running movie, where this is just one of the scenes, one of the frames in that movie. So that's at a general level. But let's talk specifically about what's going on this year. What's going on specifically this year is that the brunt of the economic pain caused by the pandemic was borne by small businesses, little restaurants, little shops. They don't have the capital, they don't have the deep pockets, the resources to renegotiate deals and all that, and leases, and they borne the brunt of the economic pain. But what's interesting is that these Main Street businesses are not part of the stock market. They're not part of the stock market. And through some twisted irony, because we changed our preferences as consumers. I love my local businesses, but because they're closed, I had to go shop online. We have given more business to the large companies that are part of the stock market, and not as much to local businesses. Even that, if that, it wasn't my intent, but that's kind of what I the biggest hit Main Street, which are not part of the stock market, larger ones which are publicly traded. But there's another thing that I want to touch on, Eileen, and that is that when you look at the stock market, it's also important to know what exactly are we measuring. So in the case of the stock market, I'll use the S&P. Through the end of September, the market was up 6%. As you said, we had the pause button, millions of people are unemployed, and you wonder, how can the market be up at a time like this? Well, if you look at the S&P 500, the way that it's computed, the way that we measure the market is by emphasizing more larger companies. So the larger the company, the greater the emphasis that it has in this particular way of measuring the market. And right now, the 5 largest stocks, I call them the FAMA stocks: Facebook, Apple, Amazon, Microsoft, and Alphabet, the parent of Google. Not in that order, but I just like the word FAMA. These 5 companies, on average, they're up about 40%. So really an incredible run that these 5 companies they've had. And they are about 20 to 25% of the value of the entire S&P index. In other words, 1% of the companies in terms of number of names, they account for about 20 to 25% of the value of the entire index. So about 20 to 25% of the performance of the index is attributable to these 5 companies that have done incredibly well. Well, what about the rest of the 495 or so companies in the S&P 500? What you see is that on average, among the rest of the companies left in the S&P, they're actually down by about 5%. So what I'm getting at is that when you're saying the market's doing well, it could be an artifact of data. And when you scratch beneath the surface, what you see is that the market has been driven by and large by a handful of very large companies that have done very well, and they have lifted everybody else. But not every company is doing well in the market, not at all. A lot of them are still hurting, and they're not doing very well at all. And in fact, even if you look at the companies and how they're doing right now, what's fascinating is that in the S&P 500, some companies are doing well, and they're not necessarily the new economy. They're the old economy. Boston Beer outperformed Amazon, and perhaps there's a reason for that. One of our friends and colleagues lives on a farm in New Hampshire, and he's going to Tractor Supply all the time, and he did better than Apple. We're all washing our hands and wiping more than ever, shipping rather than getting things locally, and doing home improvements. So when you look at these companies and the fact that they're doing well, perhaps there is a reason for that. Now, I mentioned that I was in your office. I used to travel every week. I don't do that anymore. And what happened? Airlines are down, and down significantly. I don't stay in hotels anymore. Hotels are down. I used to get a Starbucks when I got off the plane in the morning in the hotel. I don't do that anymore. I don't use my American Express for work. Don't go to Disney World anymore, or Disneyland. They're closed. And I certainly don't take a lot of cruises. So it's interesting that when you say that when people consider that the stock market is so divorced from reality, when you take a closer look, you kind of see that, not every company is doing well. These larger ones have been pulling up everybody, but even the companies that are doing well or bad, perhaps there is some intuition why their returns are what they might be.
All right. But to follow on, it does seem like the pandemic has changed the world that we live in. And this has cemented the dominance of those handful of large technology companies, because we were all changed. That we also call the FAMA stocks: Facebook, Amazon, Apple, Microsoft, Alphabet, the parent of Google. So that's led many investors to believe that won't those be the companies that will continue to dominate in the new world going forward? And shouldn't we just focus on those?
Yeah, no, it's a very legitimate question, and we've actually looked at this. I mean, to begin with, it's interesting because we have large technology stocks today, but companies being large in the market, that's not the first time that it happens. And it was interesting to ask that question, exactly that. Wouldn't a company that's large and dominant continue to stay large and dominant? And we actually looked at this data going back to 1930. As they said, we have good data going back then. And look at the top 10 largest stocks in the US market from decade to decade. And some of them, if they're just in gray, like Time Warner or Altria, the cigarette maker, they're only there for a decade and then they just don't stay there. If it's a color dot around it, that means that it was there for multiple decades. And the thing that becomes quite apparent is that if you look here, it seems that they stick around. Once you're in the top 10, you tend to stick around. And more so, AT&T was the largest company for 4 decades, 40 years, and another 30 in the top 4. So 70 years of dominance, it's a long time. And that was a technology stock of its time. Telephony was a big deal. General Motors and making cars was a big deal. Electricity was a big deal back in those days. Exxon was a top 5 stock in the 30s. It went 90 years all the way to being a top stock about 10 years ago. So certainly what it seems is that once a company gets to be so large and dominant, it's likely, more likely than not, they will continue to stay large and dominant. So as you look at the current ones, the current large companies, what do you do see? It's possible that they will continue to be large and dominant. I cannot disprove that. There's not enough evidence to say, no, they're not going to be large and dominant. What I could tell you is that the relevant question is not whether or not these companies will continue to stay large and dominant, but rather, as an investor, will they also be great places to put your money? Will they be large and dominant, but will they also be great investments? And that's a different question. So when we looked at that question, this is what we found, is that on the way to becoming a top 10 stock, on the way to becoming that large dominant company, they do have great performance. 10 years before they get in that exclusive club, they outperformed the market by 10%, which means that if the market return was 10%, they returned 10% plus 10%, 20% per year for the previous 10 years. For the previous 3 years, they outperformed the market by 24%, meaning their returns over 3 years were around 34% per year on average, which are great numbers. So on the way to becoming a top 10 stock, really remarkable performance. And that's one of the reasons they get to be in that top 10 club. The question is, what happens afterwards? Once they become so large and dominant, what happens to investor returns? And on the short run, over 3 years or so, they actually continue to outperform, but by a lot less. And once you get to 5 and 10 years, they seem to be running out of steam and actually underperforming the market as a whole. And that's so interesting. And why might that be intuitively right? Because once you have a company like Apple or Amazon or Google or Facebook, how easy is it for them to grow and double in size and even sustain the same growth that they've had? If you look at the next 10 years and they sustain the same growth, they're going to be half the stock market, and which has never happened. But what we see more likely is that once they get to this level, the returns tend to be a lot lower, partly because it's harder to grow and sustain that growth, but partly because they are now more mature, established companies. And in that respect, being a more mature company, it puts you in the category called large growth. These are large, well-established, mature stocks. And because they're so large and well-established and mature, the cost of capital changes. In other words, investors will say, I'm okay with getting paid less because I get more certainty from them. That's what large growth offers. And in fact, this is consistent with what we see in other data, that large growth stocks as a whole, they tend to underperform the market as a whole. So to me, again, the big one here is not whether or not they've done well so far, great. But looking forward, what do we see? And there are 2 comments that came to mind just as I was looking at this. The first one is that you cannot get the next Amazon by just buying Amazon. It just doesn't work that way. And secondly, think of Wayne Gretzky, and I always love that quote that what made me successful is trying to chase the puck, not what it used to be, but where it's going next. And to me, it's good that these companies that have done well, they are a big part of the portfolio. At the same time, we want to diversify because we want to go where the puck is going next. And we don't want to just, invest so much that we might miss opportunities somewhere else. So to me, Eileen, it makes sense to own these companies and they should be part of the portfolio, but I still think there's a great case about diversifying in order to capture the next Amazon, the next Apple, the next Facebook.
Right. Thanks so much for that. We do a lot of counseling our clients so they think of growth stocks to replace the adjective growth with expensive, right? But those companies are also very expensive at the moment. So also reducing the future expected return. So another issue that clients are wrestling with is the volatility in the market this year, which really has been unusual. The massive swings, sometimes even intraday, have been pretty extraordinary. Should that make us nervous as if somehow the markets are not functioning properly?
Yeah, no, it's such an interesting question because it goes to the heart of exactly what you said, markets functioning properly. So let's go back to the comment that I made, that why do you see the price of a stock the way it is? Why is Apple trading at that price and why is Amazon trading at a different price? What's the underlying reason for that? And the underlying reason is that a company's value depends on what an investor expects to get from the profits that the company makes for years and years down the road. Not just 1 or 2 or 3, many, many years. Exxon has been paying shareholders for over 100 years. So it's a very long-term proposition. So in order, what the job of the market is to somehow try to figure out, okay, if I'm going to own a piece of this company, what will I get paid for years and years down the road? And then to somehow bring those future dollars back to today's value and do it in a way that reflects on all the information, all the expectations that people have around that company. Imagine that. It is an incredibly hard exercise because you'd have to somehow try to figure out what's the company going to make next year and the year after and the year after. And particularly in a time of a pandemic like we're going through right now, really investors don't have a playbook to gauge what is the impact of this pandemic onto the company's profits for years and years to come. And because there is more uncertainty on the earnings, that's what causes investors' views about the future to diverge more. So some people might be quite optimistic about where the things are going and some quite pessimistic. And the market's trying to incorporate these, but because the pandemic has generated, just a set of challenges in terms of looking forward to what the profits might be and how these companies will operate, it's making it hard. It's not just for investors. Companies are trying to give investors guidance on earnings, and it's something that's quite common. A lot of the companies in the S&P are offering guidance on the earnings, so investors have a sense of what the earnings might be over a year or two, or maybe even longer. And since the pandemic started, many of these companies have actually stopped providing guidance because they don't know themselves. So if the companies don't know themselves, investors are flying a bit in the dark. And what you see in terms of volatility is just investors really trying to adjust their expectations based on this pretty uncertain environment. And the fact that the market fluctuates and has what's called volatility, I think that's a sign of a well-functioning market, that all these new information, that expectations that people have, they get put in the price right away. And that's why you see this more volatility. So to me, it's not a sign that the market's not working. It's exactly the opposite. It's a sign of a well-functioning market, that you have different opinions, and in times when you do have a little more visibility on what the earnings might be for these companies, perhaps it's the range of people's estimates might not be as great. But right now, since we don't have that, the range of estimates are greater, and that's what's causing the volatility. But again, to me, it's a sign of a well-functioning market rather than something is broken in the market.
Right. And we agree here too. We talk with clients about how our investment philosophy is based on the fact that markets work, right? And then any kind of forecasting, it would be based on information that somehow wouldn't be publicly available, which is, of course, is illegal. So we like to say we harness the market and put it to work for our clients. Okay, and then we want to make sure we have enough time for you to address the role of fixed income. So here at Hemington, we spend a lot of time explaining to clients the role of fixed income or bonds in a portfolio. First, why even have them in a low interest rate environment? And then more recently, we're getting a lot of questions around why have them in what could potentially be a rising interest rate environment. In addition, the Fed continues to participate in the bond market in unprecedented ways, and the government continues to borrow, all of these raising concerns for our investors. With that backdrop, many clients have been surprised that given all of that, how amazingly well bonds have performed this year. As of yesterday, the Hemington bond portfolio is up almost 7% year to date. So can you comment on how our clients and your clients at Dimensional should think about fixed income or bonds in their portfolio?
That's such a great question, because we spend so much time thinking about stocks, and yet a substantial portion of somebody's portfolio might actually be in bonds, and they're quite different. So let's see how to think about stocks versus bonds. So if you look at the stock market, what you see is that over the long run, it has delivered on average returns of about 9-10% per year to investors. But because you are buying fluctuating profits, these returns haven't been incredibly steady. In fact, from year to year, it has been all over the place. So just because you see the average, please don't expect it any given year. It could be all over the place. But it has been an incredibly rewarding ride. My dad, who just turned 93, if his parents invested $1 at the time that he was born, that $1 by the time he turned 93 would have grown to about $9,200. So the first thing to note is that when you look at the stock market, what we've talked about so far, it's really designed to provide an element of growth to investors. That's one of the primary reasons you want to have the stocks in your portfolio. Now, when you look at bonds, they have there is something different. What is a bond? A bond is basically a contract. Somebody wants to borrow your money for a specified period of time, and in the contract you kind of spell out how much you're going to get paid in interest, so you know exactly what you're going to get in interest, and at the end you get your money back, and you wrap up the contract. That's what a bond is. It's a form of a loan. It's lending your money, and the beauty is that as opposed to fluctuating profits in the market, you have a good knowledge through a contract of what you'll get paid. And let's say that you had lent your money to the U.S. government for 30 days. That's called the U.S. 30-day Treasury bill. Over the past 90 plus years, there has never been a single calendar year when you'd have lost money in the market. So never a negative calendar year, very stable relative to stocks. And you also stay ahead of inflation at about 3-4%. So the bonds are quite different in the way they operate relative to stocks. So if stocks are ownership, bonds are lending, and lending comes with more knowledge of what you'll get as an investor. And again, the good news is that you typically stay ahead of inflation, which is the big bogey. Now, to the question that you asked, Eileen, what is the role of bonds? Why should you use bonds? One of the roles that bonds can play in a portfolio is that they can help you navigate times when the stock market is not doing very well, and that's one of the primary roles. Is almost like cushion the times when the market drops and provide some counterbalance to these market drops. So if you look at this year, the U.S. market as of the end of April was down about 9% or so, and over the same time period, the government index was up about 5.7%. And as you said, even this year, Eileen, the stock market globally is not really up, but the bond portfolio is higher. And it's not just this year. If you look over the past 20 years, in every single instance when the market dropped significantly, the bond portion of the portfolio held up really well. And that's what you want. You want that counterbalance. And when the stock market doesn't do well, to have something to hold you up. And to me, that's one of the primary roles of bonds, is to provide that stability. And in that respect, even in this low interest rate environment, the bonds are absolutely doing their job. They're absolutely doing their job, even in this low interest rate environment. And that's a really good place to start. This is one of the roles. The second role is often considered to be income. Can they provide some income? Well, it turns out that in a low interest rate environment, you might not get much of an interest in bonds. On the other hand, this is incredibly beneficial to stocks. So stocks might be going up because the bond rates are low. And because of that, I think that one way to look is, rather than say, I need to generate income only from bonds, you want to have a total portfolio perspective, a holistic view, and think about generating income not only from the bond portion, but also from the stock portion. Because as I said, in a low interest rate environment, these stocks might actually be doing well, even as the bonds might not. But generally speaking, even if you look over the long run, bonds have never been a great place to generate income relative to stocks. Not generate income, but generate growth relative to stocks. So you need to be careful, because if you say, I want too much stability in these bonds or income from these bonds, you might not get it. $1 invested at the same time in these 30-day Treasury bills, even as they outperformed inflation. And I'm going to ask you, put a number in your head. If growing at 9-10% leads to 9,200, what would it be? What would the 9,200 become if you grow at a rate of 3-4%? And we have a book called the Matrix book that kind of clearly gives that answer. And that is a whopping $22. $22. It's the growth of the same dollar over the same time period in the safety of these Treasury bills. So, again, it's good to have them as a cushion, but do you want to put that, because they don't grow that much? You need to grow your money a bit, even as you are in retirement and you get close to retirement. You need to have, perhaps some portion into each. Now, how would you know how much? The only way to know is to actually talk to Eileen and Jen and Hemington and have a financial plan that takes account of your circumstances, your needs, and basically when do you need the money, how much money do you need, do you have a pension or not, what type of job you have. All these are important considerations, and only after you have those can they recommend a particular balance between stocks and bonds. But this is the most important decision in investing. And as you look into generate income, again, our view is that you are better not to just look at stocks or bonds, but look at the total portfolio, look at the total financial wealth that you have, including pensions, including royalties or rents that you might generate, and ultimately create a plan to generate income from more than just one source. And to really touch on the last one that he asked, what about the government and now all the spending? What does it mean to me as an investor? What do we see out there? In the world of investing, people can either have opinions, or they can put these opinions to work and vote with dollars. And these numbers that I'm going to show you, they're as of May, but they're not vastly different. And if you're the government, you'd like to borrow at a very low rate. You want to borrow and pay as little interest as possible. If you are a lender, you would like to receive as much as possible. So there's that tension between savers and borrowers. And right now, the place where they happily meet is at a 0.7% per year for 10 years if you're going to lend your money to the U.S. government. Now, the thing is that what's interesting is that that this, to some degree, reflects the investor's opinion about how likely is that for the entity to be able to repay the loans. And if there's a bit of a greater risk of not being able to repay, that gets reflected into what interest rate investors are willing to accept. So there's a great deal of signal that comes into this from this interest rate. And if you look at Apple, for example, it's a steady company, and Apple would love to pay 0.7 on their bonds, but the market won't let them. It's like, no, if you want to borrow for 10 years, you need to pay me more than twice than the U.S. government. Clorox is safe, as we talked about, wiping our hands all the time. They have to pay 1.8 in interest. And the more you go to, for example, a Starbucks, it's a 2.4 interest, or Southwest, it's over 5%. And Nordstrom has to pay over 8.5%. All these reflect to some degree the fact that there's a relative riskiness of not being able to meet those payments. And the U.S. government right now is in a place where people consider that it is a safe place. And if you wanted to know, not my opinion, but if you wanted to know how investors voting with billions of dollars, what do they think? This is where you have to look. And when you see these interest rates of U.S. government bonds going up relative to others, that's a signal that the market doesn't have as much confidence. But right now, the market still has absolute confidence that the U.S. Will be able to repay its debt.
Right. Oh, that's terrific. Well, Apollo, can't thank you enough. Looks like we're right at the hour. So I think we've gotten to most of the questions. As I said, if anyone added any questions in the chat or in the Q&A, we'll be following up directly to make sure you get your questions answered. But we just want to thank you so much and sincerely, Apollo, for your valuable time. We really appreciate your insight in helping us all keep our perspective, especially over the next couple weeks.
Right.
And thanks to all of you who attended. And from all of us at Hemington, we certainly hope that you and your family stay healthy and content through the next couple weeks and beyond. So thanks so much, and good night.